Okay, I'm so excited because this is my favorite part of the video. Secret number 2, the new way to save and pay for college and literally get a full college funding refund during retirement. We're going to cover 4 case studies. The first one is younger students that are saving to pay for college. The second one is a senior in high school that doesn't have any money saved for college. The third one is somebody who has a ton of money already saved for college but wants to pay for college in a way that gives them a full refund on that money. And the fourth one is for the kids that are going to be paying for their own college payments. Now, in the last lesson, we talked about how we were always trying to get into this corner where the majority of the free money is. But the reality of it is that you might have a really high EFC number and you might be able to go to a school that gives lots of discounts, but your kids might want to go to an Ivy League school that doesn't even offer any merit-based scholarships, and you're going to have to pay full price at an Ivy League school. Or maybe you have an average student, but they're going to get some scholarship money at a local state school, but they decide they want to go out of state or to a different school that doesn't offer any free money. Whatever the case may be, most families are going to have to pay a lot more for college than they would like. The reality of it is how you pay for college is 10 times more important than how much you pay for college. Getting a full college funding refund could easily be your biggest savings. Now, traditionally, there are only 2 ways to pay for college. First, there's what we would call your saver. Your saver is going to save and then spend, save and then spend. So maybe they're going to save up for college and then they're going to spend the money on college. Or maybe they're going to pay for it out of their cash flow. Maybe they have a 529 account or some of these other traditional college savings vehicles. But the reality of it is that they're going to save and then spend. The second option is what we would call the debtor, somebody that's going to actually borrow the money and then pay back the money. So they start below zero and then they have to make loan payments to be able to get back to zero. The problem is, in both of these scenarios, you're not going to have anything left for retirement. You're going to start at zero and you're going to end at zero in both of those scenarios. The most important concept to understand when you're saving and paying for college is you're going to finance every major expense in life. And obviously college is a pretty big expense, but you're going to either pay interest or you're going to give up the opportunity cost on the interest that you are earning. So you're either going to pay interest on college loans or you're going to lose the interest that you could have earned by spending your money on college and giving up that interest. So let's talk about the new way to save and pay for college that gives you all of your money back during retirement. This is a strategy. There are some components that we must have. There's 3 non-negotiable components, and then there's some nice to have features as well. First and foremost is the uninterrupted compound interest. That is a must. The key to paying for college and getting a full college funding refund is uninterrupted compounding interest. It's like the goose that lays the golden eggs. If you kill the goose, it stops giving you golden eggs. Now, unfortunately, I don't have a goose that lays golden eggs, but I do have lots of chickens. If I killed the chickens, I would stop getting eggs. Yeah, you're not going to be able to unsee that. The damage is done. Sorry about that. Hopefully, though, that helps you to see the importance of uninterrupted compounding interest. Let's just say that I have eaten a lot less eggs since we've had chickens. But that's first and foremost. The second is loans at a lower rate. So if our money is going to compound uninterrupted, then we need to be able to borrow somebody else's money at a lower rate. And the third is optional loan payments. We want to be able to have our loan payments on these loans be optional, and I'll explain why in just a minute. Now, some nice to have features are we want a good compounded rate of return, right? Everyone wants a good rate of return. We don't want it to negatively affect our EFC number. Remember, some of our college savings could end up hurting us. And wouldn't that be unfortunate if you were penalized because you saved for college when somebody else that didn't save for college gets more free money than you? We also want the fees to be low in this overall plan. We want our money to grow tax-free. We want to be able to get the money tax-free out of the plan. We want to be able to deduct the money going into the plan if we could. We don't want any stock market losses, right? And we want guaranteed loan approval. When we're borrowing this money, we don't want to have to qualify for those loans with an application and a credit check. We also want fixed loans, not variable loans, because that creates too many variables. Also, high contribution limits. Some of you have older kids already in high school, maybe even in college, so you've got to make up for lost time. We might need to save a lot of money. And you want flexible contributions, because what if you lose your job or have unexpected emergencies and you can't make payments? You need it to be flexible. And last but not least, you need access to the money. Now, you might think access to the money is a non-negotiable component, but it's not, because we can actually use our money as collateral and borrow against it instead of actually accessing the money. But it wouldn't be bad to have that option as well. Okay, so imagine this scenario. What if you could earn an average of 7% on your savings? Now, the reason why I say savings and not investments is because it doesn't lose any money. So what if you could average 7% on your savings, and you could actually use that savings as collateral to secure a loan at 5%? And now here's the crazy part. Imagine if you didn't have to make any loan payments, so that your loans could just compound interest at 5%, but your money could continue to compound interest at 7%. It's like two cars going across the country. One car is going 70 miles an hour, one car is going 50 miles an hour. By the time they get across the country, there's a huge difference between those two cars, and your money works the same way. So imagine this scenario. Would you pay for college using your savings and interrupt the compounding interest so that you would no longer have all of that compounding, like killing the goose that lays the golden eggs? Or would you pay for college with loans? Now think about that for a minute. The positive spread could give you a full college funding refund. So all of the money that you contribute to this plan, you could eventually get all of that money back in the future, simply because of what we call the positive spread on the money that you're earning versus the money that you're borrowing. Now you might say, well, my financial advisor can get me a 20% return on my money, and I can find loans for less than 5%. But what makes this strategy so unique is the optional loan payments. Think about this for a minute. Every month, you have three choices with your money. You can either spend it on lifestyle, or you could save it, or you could put it towards your loans. Now, if you had the choice and you could either put your money towards savings earning 7% or loans that are only costing you 5%, wouldn't you rather put all of your money towards your compounding interest instead of those loans? Just let those loans compound at 5% and allow your money to compound at 7%. Now, the other thing about this strategy is that you're not in debt. I know that so many times we want to avoid loans because nobody wants to have any debt. But guess what? You're not in debt because you always have the money that you could pay off the loans. At any point in time, you could transfer your money out of your account to pay off those loans. So you're not in debt because you have more than you owe. I have taught this strategy for years to hundreds of families, and the biggest challenge that people have is the mindset behind this concept, because we've been so programmed to avoid loans at all cost. But the reality of it is that some loans can be strategically beneficial. In order to emphasize this point, I want to talk about an article that came out that talked about this secret trove of information about all these billionaires that weren't paying their fair share in taxes. In fact, they went through the list of Warren Buffett, Jeff Bezos, Michael Bloomberg, Elon Musk, and how based on their wealth growth and their income that was reported and their taxes paid, the amount of taxes that they were paying is minuscule. So of course this article was so upset that these billionaires weren't paying their fair share in taxes. But what I thought was interesting about this article is how they were doing it. It says in this article that their wealth derives from the skyrocketing value of their assets. In other words, uninterrupted compounding interest. Those gains are not defined by the US tax laws as income unless and until the billionaires sell. You don't pay capital gains unless you sell the stocks. So how do these mega billionaires pay their mega bills by opting for dollar salaries and hanging on to their stocks? Well, according to this article, for some, it is borrowing money, lots of it. The thing that these billionaires understand is that they're not in debt when they borrow money because they have the money to pay these loans.